This video is designed to help Year 12 accounting students know and understand how to compare the different methods of inventory valuation in inventory cards. So that's comparing identified cost and first in, first out, or FIFO. So what we've got here is we've got inventory loss, and we've got on the left hand side here we've got identified cost, and on the right we've got the FIFO method. Both have an inventory loss of 5 units. So there's 5 units that have been lost in both. But what you'll notice is there's a difference in how we have recorded these. So you might want to pause the video now to look at what the differences are and think about why this might be the case. You can see here that in the identified cost example, we've got two different cost prices being used, whereas in the FIFO method only one. And the reason why is because under identified cost we know exactly which items have been lost. So we know that there has been, we only have 37 of the $6 t-shirts and 10 of the $7 t-shirts left. So we know what this balance is going to look like, and we simply need to adjust it for the specific items. Under FIFO, we don't know which items, we simply know that in total there was 47 units on hand. So it's gone from 52 to 47. Therefore, we apply the FIFO rules, or the FIFO assumption, that the oldest stock is assumed to be lost first. Now we can see that this has some differences in recordings, and we'll talk a little bit about that later. But you can see that the amount, the dollar amount of inventory loss is different. Jumping over into inventory gain, we can see that on the left, once again, we have identified cost, and on the right we have FIFO. Both of these transactions have 4 units gained. But once again, we can see that under identified cost, we have one way, and under FIFO, we have a second way. Identified cost, we know that we ended up with 38 of the $6 t-shirts and 41 of the $7 t-shirts. We then simply need to adjust to get to this balance. Under FIFO, we know that we had 79 t-shirts in the end, so we need to apply the FIFO assumption, which is inventory gains are recorded at the most recent or the latest amount in the in column, which would be this transaction that occurs on May 15. Once again, you can see a difference in the amounts. Here we have an inventory gain of $25 in total, and here is $28 in total. So why is it important to know how to compare these? Well, because we can be asked to talk about the differences between identified cost and FIFO, to compare what would happen if we used one method over the other, and the impact that that would have on things like inventory on hand and cost of sales. So in this example, which I've taken from the Cambridge text, we have got, similar to what we saw in the previous slides, we've got a sale on the 5th of October. It is the same amount of items being sold, 10 coats, but the first one here is using identified cost, and the second one is using FIFO. So when cost prices are rising, what I mean by that is that the older stock is cheaper than the newer stock. Okay, and you can see that the older inventory is cheaper than the newer inventory in both examples. So you might want to take some time to have a look at these examples and think about the two questions on the screen. Which of the two methods, identified cost or FIFO, will end up with a higher valuation for inventory on hand? The second question is, which of the two methods will end up with a higher valuation for cost of sales? And you can use the information in the inventory cards to help you with this. So now is a good time to pause the video, and then we'll go through and look at a solution together. So here we have our, I suppose, solution, once again taken from the Cambridge text. Under the FIFO method, we can see that there is a lower cost of sales. And we can see this because the cheaper inventory is assumed to be sold first. Now, how I can see that is by going into my inventory card. I can see that this amount here is 1140, whereas down in my FIFO transaction I can see that this is $1,040. So you can see that there has been more of the $120 stock taken out under identified cost than what there was under FIFO, and that's leading to a change in cost of sales where it's actually become cheaper under the FIFO method. When there is a lower cost of sales, that means that there is typically, in rising prices, there is a higher value of inventory on hand. And once again, we can see that from our inventory card. So under our inventory card, you can see that we have $2,060 as our balance under identified costs compared to $2,160 under FIFO. So this is an example when there is rising prices. Therefore, when there are falling prices, it's going to do the opposite. So to understand this in a bit more depth, the table down in figure 8.32 unpacks all these different parts of the inventory card with a bit more detail. So if you're a bit stuck, pause the video, have a look at the inventory cards with that table on the bottom left to help you understand why these 2 points occur in rising prices.